the US is just sucking in basically Western money. But gold is being accumulated by central bankers because they're in need of a neutral reserve asset. And gold truly now, undisputably, is the only qualifying candidate. But we think of our portfolio as having three components. They're urgently trying to get into the US to sort of pay their vig to the Don.
Okay, guys, so today we have Doomberg for the first time. I'm very excited because today we will discuss what's happening with the economy. We'll talk about commodities, some other investment opportunities, as well as portfolio structure and other very interesting topics. So thank you very much for being here, sir.
Vladislav, great to talk to you.
Thank you very much. So I would like to begin our conversation by talking about the US economy. So we have so much going on right now. We got recent economic data. We have the issues that's happening around the Fed right now. So what's your take of what's happening right now with the US economy?
So it's a fascinating question. It's hard to truly understand because Donald Trump is, a uniquely, disruptive force. And so we have a lot of cross currents going on right now. We have the issue with the tariffs and all of the disruptions and supply chain issues associated with that, that by and large is probably going better than Trump's critics had feared. There's also the economic war with China, which presents significant risk to certain critical US supply chains. There's a wave, a real wave of outside money beginning to flow into the US as part of the commitments made to Trump on his various tours across the Middle East in particular, but other allied countries as well, as countries have made commitments to invest in the United States in exchange for better tariff treatment. That money is starting to flow into the US and is creating a bit of a boomlet, especially in the private markets, as this money looks for a home within the US. And then, of course, Trump is berating the Fed chair, Jerome Powell, in a truly historic and unprecedented and potentially quite dangerous way, in our view. You got to take Trump in his totalities. Now, how all of those flows net out is the big question, very difficult to model. Depending on how things go with Russia and the war in Ukraine and the situation in the Middle East, Trump is positioning the US for a substantial boom in onshoring, reshoring, US manufacturing. Even Scott Bessent was out saying really remarkable things about Europe, basically, about how it's talking as though Europe was a colony of the United States. I'm sure you've seen this, but it's really quite incredible to see what's going on. The big unresolved issues are Brazil, India, and China, which is part of a larger sort of what we like to call World War III between the US and the BRICS countries. So lots going on, lots of ways we could take this. I'm happy to go in any direction that you think would be interesting.
Okay, so I would like to talk about the recent economic data. So in my opinion, it looks like there's a clear slowdown, even if you look at the employment revisions that just came out as well. If we look at the recent one, if that gets revised, we could very easily get negative numbers. So what would your take be on that?
Again, these numbers are very difficult to interpret because, for example, GDP swings based on imports, and there was a lot of front loading of imports ahead of tariffs that threw off first quarter numbers. Maybe this is now rebounding and regressing to the mean in the second quarter, but don't necessarily represent what historically such numbers would have represented. And so I would be hesitant to say that the data quality of the US, not just because of measurement error and historical revisions, but also because government, bean counters are trying to assess an economy that is truly unique. What Trump is doing on the tariff side of things is, in fact, well, we think wildly unconstitutional, but that's probably a discussion for another day. But it is very difficult to model. So this is sort of what we see in the energy markets all the time too. Like rig counts doesn't mean what it used to mean. Whenever you're looking at sort of historical data, there's always in the energy sector, at least, technological shifts that have occurred that make what such readings used to mean something different now. But in this case, we have a very tactically quite different economy based on the sudden change and pivots that Trump is doing, which are causing wild swings in the data that don't necessarily mean what they used to.
And if we talk about the US stock market, so I know you can look at it from different perspectives, but historically speaking, things look overvalued from the technical charts. I mean, you can make a point either way. So what would be your take on the US stock market at the current levels, and where do you believe it could be heading in the next 6 to 12 months?
Yeah, so I should start my answer by giving the disclaimer that we don't invest in the stock market ourselves, not materially, at least in our own personal portfolios. And so don't have any skin in the game per se. Um, Part of what's going on is that there's just a huge inbound um, flow of money into the US right now as part of the commitments, as I mentioned earlier. And that money's got to go somewhere. It's got to be parked somewhere. Um, and so there's value in owning US assets beyond the traditional valuation metrics, it seems. We're seeing this in the private markets as well. If you look at the valuations in the AI sector, for example, just a total bubble. Um, and so, do we think it's justifiable? Would we buy at these levels? No, no. Do we think it could go much higher from here? Absolutely. Do we think it could crash? Sure. Do we have any strong views on the matter? Not necessarily, mostly because we're not in it. And it's just not what we do, right? We don't cover individual stocks or even equities as a class per se, um, unless it involves sort of a broader feature of an energy story that we might be working on. But yeah, at these levels, we see some crazy valuations. But just because it's crazy now doesn't mean it can't get crazier. And there seems to be an endless bid for every dip, which is pretty amazing. And then the last thing I would say is, all this talk about revaluing gold. Effectively, the U.S. is running huge structural fiscal deficits. It is hard to envision a world where debasement of the currency is not part of the solution to that problem. And so owning equity in companies that may be able to outrun inflation might carry a bit more value than traditional, price to earnings, price to sales type metrics might give you. And so, the market, we're always hesitant to say the market is wrong. Um, the market is informative. The market is right a lot, and the market is telling you something. So we like to, when we see outliers, we don't try to average them away. We think they're very interesting and zoom in and see what's going on there. And I think the U.S. is just sucking in basically Western money. The world is bifurcating between the sort of Atlanticist traditional US dollar financial system, Wall Street, London, um, and then Brazil, Russia, India, and China on the other side. And so, for the countries and regions that rely on US military support for their national defense, for example, those are the countries that Trump is striking quote unquote great deals with. And the ones that don't, BRICS, are putting up a much, much more vigorous fight. Well, the countries that the US does have escalation dominance over in such negotiations, the ones that have US military bases on them, they're urgently trying to get into the US to sort of pay their vig to the Don. Our friend Marvin Barth over at Thematic Markets has had a great piece on this at the beginning of the Trump administration. The best way to model Trump was as La Cosa Nostra. This is mob style running of the US government where paying respect and paying a vig to the mob boss is what matters most. And we see this in Trump's behavior. I mean, again, Trump is a very complicated person, but I don't want to make it sound like we're critical of Trump. He's a very interesting fellow, and we have strong and mixed views of the man. But that is a very interesting model, and it seems to be working. And Scott Besant's comments, again, really remarkable historic comments right out of The Godfather.
Hmm. So I would like to talk about the US dollar. So the dollar has been quite weak recently compared to other currencies, but also if you look at the big picture with the monetary system, with the deglobalization that's happening, what's your view on the US dollar for the, let's say, 12 months and for longer as well?
Yeah. So again, the way you measure the US dollar is not how we measure the US dollar. And so basically what you're saying is a measurement of the relative strength of the US dollar is the DXY. But in reality, that is just a bunch of failing fiat currencies trading in relation to each other. Our strength of the US dollar is how many ounces of gold it can buy. And so when we see the price of gold, what we're really seeing is the inverse price of the US dollar. And so back to my comment earlier, if the US is going to debase or if it's going to revalue its gold holdings, that is a form of debasement. That is basically how fiat currencies have debased in the past. And people won't call it a default if it happens. But if the US comes out tomorrow and says we're going to mark our gold holdings at $10,000 an ounce, you know, totally possible, gives them significant relief on their short-term refinancing that's coming, which I think is significantly occupying mindshare in the White House. But that would be a debasement. And that in that world, maybe stocks are front-running such a devaluation, knowing that it's coming. So back when I said earlier, like we don't necessarily think markets are wrong. We just think they're telling us something. And maybe they're telling us that the US is going to debase by repricing the dollar against gold. So how the US trades against what essentially is a basket dominated by the euro, the yen, and the pound isn't really all that interesting to us because they're all failing fiat currencies with strong correlations.
Mm. And so I would like, so you mentioned gold, of course. And so I suppose my question would be, what's your opinion on the current valuations and where you believe the gold would head? But I suppose my question would more be, what would be the things that you're looking at to determine, where are we standing with the current price of gold?
Yeah, so the price of gold, again, we put a presentation out for our premium tier called Goldileo, the yellow rock at the center of our financial universe. We model the world with gold as a fixed entity, and everything else revolves around gold. And so right now, until the war in Ukraine, although perhaps beginning many years before the war in Ukraine, U.S. Treasuries served as the neutral reserve asset for the settlement of imbalances in international trade. And it used to be that holders of treasuries emphasized the asset aspect of it because the word neutral was assumed. When the US began using sanctions as a weapon, starting with countries like North Korea and Iran, but when they actually used sanctions as a weapon against Russia and seized Russia's foreign reserves, there was no doubt to anybody that the neutrality of US treasuries was out the window. And for most countries in the world, because the US and or Britain has been at war with many, many countries, the prospect of being in the crosshairs in the way that Putin was put in the crosshairs, while small, is never zero. And you then cannot really hold US treasuries as your neutral reserve asset for the settling of imbalances in international trade. Whereas gold used to serve that role for hundreds of years, is now again beginning to serve that role, at least in the countries directly outside of the Western financial system. People like to refer to them as the global South. China and its trading partners, Russia. And we think a lot of this kicked off when Putin started selling US treasuries in the late teens, mid to late teens, and started buying gold instead. That was sort of the beginning of World War III, in our view. In a piece that we just wrote a couple of weeks ago called Crescendo, we laid out that argument. And so the direction of gold depends heavily on the settlement of the war in Ukraine, whether World War III essentially ends with the West losing, or whether the war continues, and just how hard the U.S. fights for the U.S. dollar system. But gold is being accumulated by central bankers because they're in need of a neutral reserve asset, and gold truly now, undisputably, is the only qualifying candidate for such a role. And in a world where, at least for the 75% of the people in the global south use gold as the main neutral reserve asset, the price of gold needs to go much higher from here as measured in US dollars.
Yeah, so that makes total sense. And now I would like to ask about its younger brother or sister, silver. So, of course, it gets influenced by both the monetary side and the industrial side. But I would just love to hear your thoughts about how you're viewing silver right now with the current price and the current environment.
Yeah, so this might annoy some silver bugs, but we view silver as an industrial metal. Um, it is no longer a monetary metal. It has echoes of being a monetary metal, but the reason why we're seeing these diversions in the, silver to gold chart and all of that stuff is because gold is reascending as neutral reserve asset. Whatever manipulations of the gold price that were occurring are unsustainable in this environment. That the opening of the China Shanghai Gold Exchange has made it very difficult for anybody to try to keep a lid on the price of gold. Um, and so silver is a monetary metal driven by industrial demand, especially in the solar market, which is booming. It'll trade like platinum and palladium did. And it is no longer sort of, I don't think it should be spoken of in the same context as gold. I think it should be spoken of in the same context as nickel and copper and palladium and platinum. And so, you know, in a world where solar demand dries up, it'll be very bearish for silver. In a world where China keeps growing solar capacity at 40, 50% a year, which seems unsustainable, it would be very bullish for silver. But people who argue that silver and silver's price should be somehow still correlated to gold, I think are missing the fact that silver is now an industrial metal. The stock to flow ratio is just so different from gold's that I don't think this is they're holding on to a history that no longer exists.
And that's not necessarily bad because, in a way, it's easier to model
Hmm.
silver based on the demand and
Yeah,
yeah.
100%. And so, but again, the people who are wildly bullish silver aren't making those arguments. They're talking, but largely speaking, I should say, not everybody, of course. I have very smart friends who are long silver that have a case that they've thought through. This is just not what we do. And so, but to the extent that, um, you begin your analysis with silver as gold's sibling, I think that's just not true anymore.
And would you be bullish on the whole commodity sector with the deglobalization that's happening right now? Because it looks like, in a way, countries will try to get their own supplies of critical materials. So, and if we look at where the world is going with the AI, with the data centers and energy, the whole commodity sector looks very bullish for the next decade or even further.
So again, we have a bit of a contrarian view then. Um, the long-term real price of all commodities is lower. And, take gold out of the equation because we don't think gold is a commodity. Um, oil, gas, you know, um, nickel, copper, lithium. In the long run, price is cured with gluts. All shortages are followed by gluts. The oil and gas energy mining companies are deflationary machines. And in the long run, we wouldn't invest in a commodity or a commodity producer, with rare exceptions, um, because the long-term real price of all commodities is always lower. And if you doubt that, just go ahead and plot soybeans, corn, diesel, gasoline, oil, natural gas, copper, zinc, nickel in ounces of gold, and draw a 40-year chart. And we tell people if you want exposure to quote unquote commodities, just buy gold because gold will, in the long term, outperform them all because you're basically buying a deflationary asset. It's kind of like volatility. So what happens in this market is you occasionally see these super spikes because the elasticity of demand is such that shortages are often coincide with huge price spikes, and that's very seductive for people. Silver went from 35 to 120, or oil went from 60 before the war to 125. Um, our view is it's almost always better to wait for such Icarus prints, let them come back 15, 20% from the high, and then buy a 6-month out of the money put, because prices always converge down quickly. And all supply shortages and price spikes are followed by gluts. We saw that in the natural gas market, LNG market. We see it in the oil markets. Um, and 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 the E&P companies, the energy companies, the mining companies have no discipline. I mean, I just think it's historically self-evident that, they will overproduce given the ability to earn their cost of capital, and they take that opportunity to overproduce. And so we would rather fade super spikes than try to time them. That's just our philosophy. There's no question that occasionally you find, a part of the market that is short or tight. Now, when you say rare earths and other things, we would separate those from the traditional commodities. Those are the specialty commodities, low volume, um, expensive, critical need, small part of a very valuable product. That's more like a specialty chemical than a base polymer, to borrow an analogy from the chemical world. And so we would say, sure, rare earths, graphite, pick your favorite sort of reasonably low volume commodity that is critical for the military industrial complex. Those are like actionable ideas, but betting on the long-term price of copper, um, just buy gold.
Right. And staying on the topic of gold. So with that being said, I assume the miners should look interesting to you right now because
Mhm.
even at the current levels, the good companies, the big companies, they're printing cash. We've seen the Newmont, the Agnico, they're doing really well. And if there's still potential for the actual commodity to go further, the margins could get even better. Now, of course, there's inflation concept to that, but I would just like to get your view on the
Yeah.
mining sector.
Yeah, we had a whole section on this in our talk called why are gold miners hated? Right? Like they're very hated for a bunch of reasons. First of all, they have a history of an ugly history around this whole concept of project financing, where they sold, future gold, pulled out of the ground and into the spot markets today, which kept prices down. And then that all unwound in a very ugly way when the price of gold started to go up and margin calls were missed. And then the other thing is the sector is just filled with fraud. No other way to say it. A lot of junior miners listed in Vancouver, pump and dump schemes, you know, um, assay fabrications, you name it. And so to many, sort of to the traditional money allocators, the big pension funds, and the sector is just uninvestable. Now, to some, that means a great opportunity. The classical value investor mindset is we have a well-run company with a good management team that is looking out for shareholders and throwing off a ton of cash, and it's selling at, a PE of 7. Great. That's a different calculus, but that is traditionally not how the gold miners have operated. And the people who tend to be interested in investing in such stocks are looking for that home run, that penny stock home run. And so that's why we believe that these opportunities exist. Just again, to some, that's great. They're always happy to buy at such times in the cycle. But that is, we're more interested in why it is that despite this run up in gold, and despite the fact that the sort of champions of the gold miners are, as you correctly said, throwing off a ton of cash. Um, and one last point is that it's also potentially especially attractive for them because like their main input cost is diesel, you know, and oil is in a supply glut. And so on a real basis, again, the price of oil is lower in the long term, and that's an additional bullish tailwind for these gold miners. So in theory, that should make a pretty attractive investment. Since we don't do such things, of course, we don't recommend how people go about that. But yeah, we're observing the gold miners just like everybody else, and it is a fascinating thing to watch.
And what would your view be on the royalty model inside the precious metal sector?
Yeah, that's a much better model, but of course it's a popular one and properly priced. Our entire view on the, say, take the oil and gas sector, for example, because a very similar model there. Um, Anything that is leveraged to volume and not price is interesting to us. Services, critical engineering, royalties, licensing, patents. You've invented something that allows natural gas drillers to get 20% more gas out of each well. I'm making something up for effect, but you'd want to buy the companies that are exposed to volume because the human endeavor is, you know, is the energy consumption always goes up over time. It's somewhat like the easiest bet in the world. Um, the human endeavor, of course, being a constant, unrelenting struggle against the forces of entropy, which requires the wasting of copious amounts of heat to impose order on our local environments. And so when you look at the Statistical Review of World Energy's annual total energy consumption at exajoules, it is a straight line up and to the right with a slight sinusoidal wave to it because there's a timing mismatch between the capital planning cycle of heavy industry and the broader business economic cycle. So not to get too technical, but that's how we view the world. And so, that volume is going to go up. Let's slam dunk bet. And any entity that is tied to increasing volumes of critical commodities is much, much better than the exploration and production side of the equation or the commodity itself.
That makes sense. And so I would like to see the way you guys are thinking about structuring portfolio in the current environment. So what would be the things that would influence your decision about structuring portfolio for an individual or in whatever way it could be in the current environment?
So we run things a bit differently here, and so I'll just give you how we do it, and it might not be sort of a traditional answer, but we think of our portfolio as having three components. The first is we earn in fiat. So, we are earning, we're building Doomberg, we're operating a business. We like to own businesses that cash flow. And we live in the fiat world, pay our bills in fiat, buy our groceries in fiat, fill our vehicles with fiat, send our kids to college using fiat. So you have to be in the fiat world. There's no escaping it. Second, we save by buying real assets, gold, land, collectibles that we understand. And we view our savings not as investments, but as putting a floor under our net worth and the net worth of our future generations. So, for example, 20 gold eagles today will buy you a very nicely appointed mid-size SUV, and 20 gold eagles 15 years ago would do the same, and 20 gold eagles in 20 years will do the same. So, again, when we look at the price of gold, the real calculus we have is how much of our savings do we want to be in gold and should we rebalance? That's about it. We don't look at it as an investment. We don't try to time the market. How many ounces do we have? How many acres do we have? How many collectibles do we have? That's our savings bucket. And then in our third bucket is we invest privately where we can personally impact the outcome. And we are betting on our ability to create what we call sweat alpha. Our contacts, our knowledge, our experience, our relationships with the founders, our relationships with the operators, our relationships with the other investors and so on, creating an ecosystem where we could compound our wealth in the private markets. That's not for everybody. Private markets are a bit of a wild, wild west. We like to joke that, we tell our children that they haven't learned how to date until they've broken up with somebody, and you haven't learned how to invest privately until somebody's stolen from you. Those are just like the rites of passage to be a private investor. And so the world of private investing is just substantially different than picking stocks, and typically much, much earlier. And the reason why we're attracted to much, much earlier is because there's so much value to be created and shared with your early owners. And so that's just how we've decided to operate our portfolios, which is one of the reasons why we don't invest in the stock market, because our investing allocation goes towards compounding our wealth with our own hands and brains and phones and address books, which has worked quite well for us. And in that world, a couple of home runs really can be sort of life-changing. And so if you're earning a lot of fiat and saving a fair bit, you're putting the floor of your family's net worth higher and higher and higher, and then you're taking bigger swings in the private market where you can directly impact things. That is the way that we have found has been optimal for us as we build out our own personal portfolios.
Yeah, that's a very, very interesting perspective. Thank you very much for that. And that actually ties up with my next question. So I like to ask this question for the younger audience. So if we have a younger individual who's still at the start of their wealth building path, and they have so many choices, they have, the crypto sector, the commodity sector, whatever it may be, what advice would you have to that individual on how they can, start their wealth building path the right way, I suppose?
Yeah, so I would say the best asset for a young person to invest in is themselves and their skills. It sounds corny, but actually it's not. And if I could look back at my young self, I did that quite well. Invested in my own personal skills, betting on in the future being able to compound wealth with my own hands and brains. Um, and I would also have opened the risk aperture a little wider, a little sooner. Um, when you're young, you have lots more time to bounce back from failures and frauds and misses. Um, and you're learning things. But I think, as we think about educating our children and setting them up for success in life, um, learning how to compound your own capital by developing your own skills and not the types of skills that like you'll get from a traditional education necessarily, but things like how private markets work, contracts. A contract's only as good as you're willing to sue to enforce it. There's all manner of little life lessons in the entrepreneurship side of things that I think are not taught in traditional or even MBA type programs. And that can only be taught by experience. But the biggest investment class is not crypto, it's not commodities, it's not stocks, it's not gold. It's you and your individual skill set, your ability to earn, perhaps uh, uh, in a job in the beginning, and then you save up enough capital that you can compound your capital yourself. Um, and then the other thing I would say to young people is you have to master your calendar. The biggest life hack that Team Doomberg uses is we optimize what we call our get to have to ratio. So divide your daily and weekly calendar into things that you get to do and things that you have to do, and outsource all the have tos and focus on creating wealth doing get to do activities, and you'll be well on your way. That's probably non-traditional advice, but that's certainly the advice that we give our children.
That's a very good one. Thank you very much. So just before we wrap up, I would like to get your thoughts on the crypto sector. How are you guys viewing it in
Yeah,
general?
our views on crypto have evolved so again, we think laterally at Doomberg, so we have some off the wall mental models, but I think that's what makes our product popular. And we make people think and give them a way to look at things. We believe that the entire crypto project is a way to create a bid for short-term treasuries. You really can't get into the crypto world without going through um, a stablecoin. And the US just passed the law that mandates that stablecoin holders buy short-term treasuries with the dollars that are coming in. It's a great deal for those operators of those stablecoins because they get to clip the coupons. The people coming into the crypto universe get a dollar with no interest, and then they could go and buy other things with it and speculate with it in the casino. But at the casino, the house always wins. And the US wants the total global stablecoin market cap to be measured in trillions because that is a steady bid for short-term US paper. And so once you have that as a mental model, the formation of a crypto reserve, Trump issuing Trump coin, the intent is to create a bubble slash mania in that world in order to inflate the market cap of stablecoin operators. It's a cynical view, but I believe it is one that matches reality quite well. What does that mean for asset prices within the crypto world? Don't know, but that boom is coming. Play the pieces as they lie, and that's what we think is going on.
Yes, that's certainly a very interesting perspective. So these are all the questions I had, sir. Is there anything else that you have on your mind that maybe we haven't mentioned that you're thinking about? It could be anything.
No, we had a pretty thorough trip around the world. Thanks for having me on. I would only say that if people are interested in finding our work, they can head to doomberg.com, Doomberg. All of our work is there. our articles, our premium tier presentations, our podcast appearances like this one. Vladislav, it was great, and happy to come back on anytime you'll have me.